Howdy. Welcome back to Dion Talk. In today's video, I'm going to cover one of the challenges a lot of new investors face, and that is, how do you qualify for more than one mortgage? If this is your first time on my channel and you would like to learn how to make work optional become financially independent in 10 years or less, basically for the average person, make sure to hit like and subscribe. That way YouTube is more likely to share my content with you. And at the end of today's video, I'm going to share the one thing that I do that has made it possible for me to get my strategies down to a science. Most of us understand how to get that first mortgage. The idea is you pay for a place to live. So when banks are looking at lending you money, which is what they want to do, remember when there's money sitting in a bank, that's a liability to the bank because they're paying somebody interest on that money. Their goal is to lend it out and make more money than what they're paying on it. The steps to get this first mortgage are pretty simple. Most of us understand that we need to save some money, have the down payment or the reserves that we're going to need. We need to work on our credit score with a goal of getting it as possible to 740 or higher because that gets you the best interest rates. Then we want to talk to a lender and find out what we're qualified for. Figuring out the amount that we can borrow helps us narrow down what we're going to look for when it comes to houses. Then we reach out to some agents, set up some auto searches, figuring out where we want to buy the property and the type of property that we're looking for. That first mortgage, pretty simple. You didn't have to do those steps in that order, but those are basically the things you need to get done to get into that first place. And just a bit ago, you heard me talk about how lenders want to lend out the money because money sitting in a bank is a liability to the bank. And they want to lend it out and make more money on that than what they're paying in interest. And if you're old enough to remember, one of the things that led up to the housing crash in 2008 was that lenders tried to lend out more money than people should actually be borrowing. We had options like ninja loans, where you had no job, no income, no assets. You just signed a form telling the bank how much you made, and they would lend you money based on that. We used to have adjustable rate mortgages. I mean, those still exist, but not as many as we used to have. And the idea was you'd get a good interest rate now to entice you into that mortgage. And in a few years, when you expected that the adjustable rate would go up, you'd probably refinance into a new loan. But when prices dropped, people lost the appreciation and principal paydown that they were counting on, and they weren't able to refinance. This is where a lot of people got into trouble. So the lending procedures in place now in 2020, 2021 are a lot more strict. Now lenders are actually requiring proof of income, usually 2 years, tax returns. They contact current employers to make sure you're currently employed, especially with the pandemic. They're going to want you to have reserves. Some of the lenders I've worked with have required 3 months principal, interest, taxes, and insurance for every mortgage that you have. So the more mortgage you have, the bigger that number will be. Some have required up to 6. A quick tip about reserves is that money doesn't have to be sitting in a bank, or it doesn't have to be cash. It has to be seasoned. You have to have a known source, and usually they're going to want it in your account more than a few months. But what I've done is I've been able to use a retirement account as a reserve. Lenders will usually recognize 50% of a retirement account as a reserve. If you have $100,000 in a retirement account, you're going to pay taxes when you pull it out. You're going to pay a 10% penalty, but you'll have at least 50% of that money left. You don't have to actually pull this money out. You just have to have proof that the funds are in there and that they've been in there for a few months. So that's a good way to get around not having a bunch of money sitting in a bank when you're buying properties. And it's possible to get loans if your debt-to-income ratio is higher than that. But the better the debt-to-income ratio, the safer bet you are for the lender. Now, remember, the lender wants to lend you money, but they don't want to lose it. I grew up often hearing my dad say that a bank won't lend you money if you need it. They're only going to lend you money if they can make money off of you and they know they're going to get their money back. So the reserves and your credit score are the first things that they look at, but that debt-to-income ratio becomes really important when you start getting more than that first mortgage. So at some point, the mortgages that you have as you add property after property is going to be much more than the amount of money that you have coming in from your job. This is my last purchase. This was a triplex that I purchased in November of 2020. Basically, when the world was panicking, thinking that the housing market was going to come to a crash and everyone was going to lose all of their money, I was trying to figure out a way to take my money from a bank and put it to work into a property. Purchasing this property added to my cash flow. I'm getting better than a 10% cash-on-cash return based on the amount of money that it cost me to acquire the property. I'm getting principal pay down from the tenants. I'm going to experience appreciation on almost 4 times what I spent, and I'm going to get the tax benefits. But how could I add another mortgage? This is a 5th mortgage for me. There are a couple of factors that allowed me to get this 5th mortgage. The first one is how many mortgages can you have in your name? Some lenders will let you have up to 4, some will let you go up to 10, and that's per person. So if you're married, you can get up to 20. And what I'm talking about today is residential loans, 4 units or less. If you go 5 units or more, you're talking about commercial. And there are some options to use commercial loans for 4 units or less too. And someday I'm going to make a video about why I choose to stay with residential loans instead of commercial loans. But not today. The second factor is rental income. The goal when you're buying these properties isn't just to buy a property and have a mortgage, it's to actually make money from that purchase. And if you're buying them right, where you're getting cash flow, my goal is at least a 10% cash on cash return. Yours might be higher or lower depending on your market. I made a video explaining how I factor my return on a property, and I will leave a link to it in the description below. The third factor that lets a person keep adding mortgages is the one that trips almost every investor up, and that is time. Remember, the lender is trying to make sure that you're a safe bet. So, if your plan is to buy a bunch of rental properties in 1 year, you're probably going to have a problem with your debt-to-income ratio. What the lender's going to want to see is that you not only know how to run the numbers and figure out what's going to have a good return, but can you actually manage a property? Do you know how to calculate the cash flow and include things like vacancy, repairs, maintenance, CapEx? Are you actually going to run a profitable business? So one of the first ways that a lender knows that you're able to actually own rental properties is by checking your tax returns. The first rental property will probably push your debt-to-income ratio up some because you don't have proof of rental income on your tax returns. But after a year or two, you can actually show those returns to a lender and say, here's my proof that I know how to find a tenant, keep a tenant, collect rents from a tenant, whether it's you or a property manager doing it, your tax returns are what actually shows the lender that it's happening. And hopefully you understand that there are 4 ways that rental properties pay you. The first is cash flow, the second is appreciation, the third is principal pay down, and the fourth is the tax benefits. One of the things to be careful with the tax benefits is not showing a loss that's so bad that your rental income won't help your debt-to-income ratio. So I would make sure to tell your CPA that your goal is to show that you're running a profitable business so that you can qualify for more mortgages. And I do recommend using a CPA. Unless you have all the time in the world to learn all the tax benefits. Because as soon as I found out that there were multiple types of depreciation, you have scheduled, bonus, amortized, way too much information for me to learn, so I rely on a CPA to take care of all of that for me. But letting them know that you're trying to actually show a good debt-to-income ratio will help your CPA do the taxes in the best way to benefit you. So having this proof of rental income helps your lender qualify you for the next mortgage. In addition to this, once you have a track record of owning properties, having tenants, running a profitable business, you can actually use future projected rents in your debt-to-income ratio. The way this worked for the lender that I was using is if I could show leases that had at least 3 months remaining on the current lease, they would factor the rent from the property that I was purchasing in my debt-to-income ratio. This is one of the reasons why I've preferred to have year-long leases or 2-year-long leases. The first reason is because I'm super lazy and I don't want to deal with the tenant turnover. But the second reason is it helps you qualify for the next mortgage. And if you're curious how you get a tenant to actually ask you for a long lease and ask for rent increases, I have a tool that gets tenants to do this. And I made a video, I will leave a link for it in the description below. Hopefully now you're understanding that the rental income from the properties that you're purchasing is how you offset your debt-to-income ratio. Showing that income on your tax returns and having leases in place is the way that you show a lender that you're a safe bet. At the beginning of today's video, I said I was going to share the one thing that I do that has given me the ability to get my strategies down to a science. And it's really simple. The thing that's made me understand what I do, how I do it, and the easiest way to do it where I don't even really have to think about it is teach these strategies to somebody else. The highest form of learning is teaching. For me, this started by answering questions in the Facebook groups like the official BiggerPockets group or the Real Estate Rookie group. And every time I answered a question, I realized that there was a part of my strategy that I didn't understand. So a little bit more research and I was able to put this into a clear, concise answer that made it really easy for me to follow through with my strategies. And here are links to the videos that I talked about earlier today. If you liked this video, if you thought you got anything out of it, please hit like, hit subscribe, share it with a friend. Maybe they can benefit from it too. Until my next video, thanks for coming to my Dion Talk.
We're sorry, the number you have dialed is not in service at this time.